Hi everyone, this is Brian Neal with TradeToBeFree.com, and just want to give you a market update here. Over the past week or so, we talked about last week how the market was pretty primed for a pullback. We normally see a pullback sometime in early August, or we often do anyways. A day or two after we published the video in the daily alert, we went bearish on Thursday evening because we noticed that we had 5 higher volume down days. We had a lot of institutional selling. You could see on the charts where on these little rebounds here, especially on Thursday, a lot of sellers came in and sold the market down. We saw the new tariffs went in or were planned to go in on September 1st, and the day before we had a response from the Fed, a cut in interest rates that wasn't as strong as some people wanted to see, and also some commentary that may indicate that they might be one and done. And so the market was concerned about that too. And so we had 2 heavy volume down days last week, and that tipped the market into a new pullback. And we had a bearish market signal on Thursday, which is, I believe, right here. So in the daily alert, when you log in, you can see the latest alert. Thursday of last week, you can see how it went bearish. And at that point, what do you do? That's the big question. And for us, what we do is we look at our existing positions and we cut the weakest ones, the ones that are underwater, the ones that aren't doing a whole lot, the ones that we're not really that sure of and aren't our best positions. We'll go ahead and cut those, and then we'll take a look at the rest and keep the best and see what kind of rebound we get. Okay, and that first rebound after the bearish signal. So we get the bearish signal, okay, and we get the big move on Monday on more reaction from China, lowering their currency, and back and forth between the U.S. and China and trade, and the next move and so forth. We got a test of the 150-day moving average very quickly. That was on Monday, and now we're finding some footing down here, a little below this 50-day moving average, and we'll see if we get a rebound at this point. I wouldn't be surprised if the market rebounded back up to these moving averages in here, horizontal resistance levels, 8100, 8050, maybe in that area we'll find some resistance and pull back again. Or we might, cut right through there. We might get some more rumors on trade that are positive and rumors on the Fed. Maybe the Fed governors will come back and start issuing statements that are more dovish, and we'll get people excited about that, and we'll cut right through these and hold above these moving averages and continue on to test the highs. So this rebound is very telling. Okay, until then it's going to be kind of treacherous with most long trading strategies and even short strategies, because we could get a strong rebound down here too. So right now we're seeing volatility up in the 20 to 25 range on the VIX. And once we see that kind of volatility, that kind of takes us out of our one of our favorite strategies, which is the earnings eruptions trade. In the course, we talk about watching this fixed volatility index, and if it starts getting and holding above 18, then we want to just be very careful with those, because they'll tend to have a lower win rate. Okay, now some will still do well, but a lot of them won't. Okay, so the win rate goes down to a point that unless you're really experienced with it, and unless you have a really big one that's coming up and it meets all the other requirements in the strategy, then I tend to avoid it. There's other smaller trades. If you have, I'll show you one here. This is a more advanced strategy in this kind of market environment, but I'm going to show you what I was looking at today on Guardian Health. And we had a opening range here in Guardian Health with a big beat and raise last night, and we had this opening range, and it broke above that opening range here. Now, the problem with this trade from the get-go is, from a technical standpoint, you still have the pre-market highs to deal with, and you have a lot of trading activity that was going on pre-market above the current price. Okay, so it's good that we're getting above the all-time high, and we have this opening range here, so the volatility is settling down. On these recent IPOs, it's just too much volatility early on, and you often see a sharp pullback after the open. So it gets really tough, especially when the VIX is so high to trade these to begin with a tight stop loss, and it's very, very tough to do that. But if you want to go for this trade here and you want to play this breakout into new highs, all-time highs, which is right around 106.50, you can see it testing that area right here early on. And then once we break out of that opening range, this may go and break through the pre-market highs, and we may have a large ABC up pattern on this stock. So if you look at the price where it was before the close yesterday, before the big news, we got the big initial move higher, we got a pullback, and so we may see an ABC up pattern where we break through these pre-market highs and continue on. And sometimes you get that even with volatility this high. Other times you don't. The win rate just drops, okay, in this kind of environment. You notice that with Guardian Health, it just didn't break out of this pre-market range. We were watching NVTA this morning too, and another big beat and raise, and they never really reached the entry point in the strategy. Sedge did, but Sedge turned over right away, tried a couple times and failed. Match reached the entry point, okay, made a nice move higher, but you're going to see a lower win rate in this kind of environment. And so that's why I say to avoid trading this opportunity, these patterns when the volatility is this high. So, when you see that volatility spike like that, you get chopped out of a lot of trades, and you can take these trades, but you have a lower win rate for one, and you have to take a smaller position size because you generally need a wider stop loss. Now, you can play with a tighter stop loss, and either they go or they don't. That's one approach. I'd rather not have to have the higher loss rate and would rather trade a less volatile market for these strategies and go for the big win rather than these little day trades of a few percent or at most during the day. I mean, the win rate on these little day trades are going to be lower in this kind of environment. The average profit is lower too, so I would rather wait for something like ENPH, that came up last week where it had a beautiful pre-market pattern, a big beat and raise, and you can see it here, and at a real nice entry point at the open. We added entry point we teach in the course. It took off. We ended up taking a lot of our shares off at like $30, around $30. I'd rather go for that 10%, 15% move with a high probability of success rather than try to play this sort of choppy market action when the volatility gets really high. So with the earnings eruption strategy, I tend to, especially when you're beginning with it, to go after these ideal setups where you have the volatility lower and you have a better pre-market pattern that fits all the rules in the course. NVTA didn't, and neither did Sedge, and neither did GH. So, if you have higher volatility, at least have a really good pre-market pattern and have it fit all the other rules. I mean, this one almost did. Match almost met all the rules, but it didn't, and it still made a nice move. But again, the win rate's going to be lower in this kind of volatility. So this is a good time to get on a simulator, learn your favorite strategy, make sure you're good at it, you understand the rules, and to keep your powder dry, cut your weakest positions if you're trading. Of course, in your long-term portfolio, you can talk to your financial advisor about that, but generally it's, you just stay the course. If you can wait 3 years, 5 years, or 10 years, but these trades aren't for 3 years or 5 years, they're for a few days to a few weeks or more. And so we want that volatility to be within reason, and we want that market trend to be in our favor. And right now it's being tested. The uptrend's being tested, and it looks like we'll most likely see an intermediate term downtrend, meaning a downtrend that lasts for a few weeks to a few months, the way it's setting up here. And we want to wait for a confirmation of a resumption of the uptrend. And until then, we're going to have a lot more volatility, lower win rates, some more difficult trading environment, especially now that we're in August. So we'll wait to see how things rebound here. It looks like we're trying to get a rebound going at this point. We closed well below the Bollinger Band. We're finding support at the 150-day moving average on the NASDAQ. We see the bearish market signal. We've seen that signal. It doesn't mean that we'll go into a larger correction here. There's a good chance we will, but if we start rallying higher again, going through these moving averages here and holding above those and getting some volume building as we do that, probably on rumors of a trade deal or rumors of, more dovish Fed, accommodative Fed, most likely. If we see that and the price action to match, then we'll get more aggressive and look for more swing trading opportunities on the long side. Until then, we'll assume that we'll get, probably a weak rebound, find some resistance up in here or sooner, and then look for some good short opportunities off this rebound. More short term than long term, because again, we're still in a long term multi-year uptrend going back to 2009 overall. So until that breaks and we have strong evidence of that breaking, our bias is still bullish for longer term swing trades. Okay, that about wraps it up. Good luck in your trading, and we'll talk to you again real soon.